Hello everyone, this is my first video on this channel. I'm going to create videos on 3rd Sem BCom subject corporate accounting under Bangalore University. As this is my first video, if there is any queries, doubts or suggestions, or if you want me to create videos on other languages like Hindi or Kannada, please let me know in the comment section below. Please ignore the background noises. So the first chapter in our syllabus is underwriting of shares. Meaning of underwriting. So for a public company to start operating, minimum 90% of the shares or capital should be subscribed by the public. If the 90% of the capital is not subscribed by the public, the public company cannot start. They cannot start operating. So if the public is not going to subscribe this 90% of the shares or capital, the underwriters come into picture. These people, they'll underwrite the shares or debentures issued by the public company for a certain amount of remuneration called as underwriting commission. So I'm going to read out the meaning of underwriting. From this, you'll better understand the meaning of underwriting. So please concentrate. Okay. Underwriting is an agreement entered into by a company with one or more persons. So underwriter can be a one person, or there can be two or three persons who will underwrite the shares or debentures of the company. So underwriting is an agreement entered by a company with one or more persons called underwriters or underwriter, who undertake to take up the whole or a certain portion of the unsubscribed shares or debentures of a company for a certain remuneration called underwriting commission. So these underwriters can take up the whole or a certain portion which is not subscribed. So they will take up the whole, or they can also take up a certain proportion which is not subscribed by the public. So if a public company is issuing 50,000 shares, and please concentrate, okay, if the company is issuing 50,000 shares and public is subscribing only for 30,000 shares, the remaining 20,000 shares will be subscribed by these underwriters, or else it can also undertake the whole 50,000 shares, but for a certain remuneration called as underwriting commission. So these underwriters are taking up the unsubscribed shares of the public company. For that, this public companies should pay them a certain amount, that is called as underwriting commission. So next is the meaning of underwriters. So underwriters are those who underwrite the shares or debentures issued by a public company. These are the people who underwrite the shares or debentures issued by a company. So they can be any institutions like banks, specialized financial institutions, firms and joint stock companies who are registered under SEBI, Securities and Exchange Board of India. So next, underwriting commission. What is underwriting commission? The consideration payable to the underwriters by a public company for underwriting the shares or debentures is called underwriting commission. The commission or the amount which is payable by the public company for underwriting their shares is called underwriting commission. There is no need for more explanation. I think if there is any doubts, please put it in the comment section. Okay, I'll be clearing your doubts. So there is some limit for the underwriting commission. It's not that how much ever the amount underwriters ask, you can just give them. There is a certain limit for the underwriting commission. For shares, the rate of commission must not exceed 5%. So this is the important thing. Okay, if in the question they have not mentioned anything about the rate of the commission, so I'm talking about the practical section. If in the question they have not mentioned anything about the underwriting commission, then you will take it as 5% as default. For debentures, it is 2.5%. If they have given any rate, you should take it directly. They have not mentioned, it is 5% for shares and 2.5% for debentures. That is the important thing, so I have stressed more on that. So what are the advantages of underwriting? Removes uncertainty of subscription. So there is no need to be afraid about the subscription, because there are underwriters. If public is not underwriting, there are underwriters to subscribe. So there is no fear or uncertainty of subscription. Easy to get certificate of commencement. There is no need to wait. Or if the public is not subscribed, it's like you can't start the company. It's not like that, because you have underwriters. If they are not subscribing, underwriters will subscribe. So you will get a certificate of commencement. So benefit of financial advice. As these underwriters can be any firms or financial institutions or banks, they have better knowledge about the market. So you'll get a financial advice from them. So it is a benefit of financial advice. I hope you are following me. Uh, Need not to bother about the condition of the capital market. So you don't need to bother about the condition. If the public is not subscribing, only underwriters are there. So there is no need to worry if the capital is going, if the capital market is high or the capital market is running low, because underwriters have subscribed. You don't need to fear about the capital market. So you have two types of underwriting. In this video, basically, I am just going through the theory of underwriting of shares. So types of underwriting, there are only two types of underwriting: on the basis of number of shares or debentures underwritten, and on the basis of liability of underwriters. So on the basis of numbers of shares or debentures underwritten, there are two more types: complete underwriting and partial underwriting. So we'll see what is complete underwriting and partial underwriting. So what is complete underwriting? A complete underwriting is one under which the whole of the issue of shares or debentures of a company is underwritten by one or more underwriters. So you can understand the meaning in this sentence itself, but I'll give you an example. So just imagine that a company is issuing 50,000 shares, and if the underwriters are subscribing the whole 50,000 shares, it is complete underwriting. They are subscribing the whole share. Okay, whole issue of shares. Next, partial underwriting. A partial underwriting is one under which a part of the issue of shares or debentures of a company is underwritten by one or more underwriters. So in partial, as the name suggests, only half is underwritten by the underwriters. So if the company is issuing 50,000 shares, this the public has subscribed for 25,000 shares, the remaining 25,000 shares will be underwritten by by the underwriters. That is partial underwriting. So next, on the basis of liability of underwriters. In this you have pure or open underwriting or firm underwriting. So pure or open underwriting is, under this type of underwriting, underwriters undertake to subscribe for shares to a certain limit only when the offer which is made to the public is not fully subscribed for, that is the balance of the shares to be taken over by them. So what is pure underwriting? See, for example, this public company is issuing 50,000 shares, and public is subscribing for 35,000 shares. Okay, uh, then the balance of 15,000 shares will be subscribed by the underwriters. So after the subscription of public, whatever is left out will be subscribed by the underwriters. Then firm underwriting, this is very important. Okay, firm underwriting, we have sums in firm underwriting. A firm underwriting is an arrangement under which an underwriter or underwriters make a definite commitment to take up certain share or debenture of a company, irrespective of the number of shares or debentures subscribed by the public. So in firm underwriting, what is happening is, at first itself, underwriters will tell, like, if the public company is issuing 50,000 shares, the 30,000 shares will be underwritten by this underwriters. Whether the public is underwriting for 50,000 shares or for 60,000 shares, irrespective of what the public is subscribing for, this 35,000 shares what the underwriters are decided on, that would be given to the underwriters itself. Okay, that is firm underwriting, that they will take a firm decision that they'll undertake 35,000 shares, whatever the situation is or whatever amount of shares is subscribed by the public. That is firm underwriting. So, next two small topics we have: marked application and unmarked application. So, just think normally, what is marked application? Where it is marked, the applications received by the company bearing the official stamp of the individual underwriter or the respective underwriters are called marked application. See, as I said, it is marked, okay? It has the official stamp of the underwriter. So, it is an application which is received by a public company bearing, it has a official stamp of the underwriter. That is marked application. What is unmarked application? It is easy now. Okay, so what is unmarked application? The applications received by the company directly from the public which do not bear the official stamp of the underwriter or underwriters are called unmarked application. That's it for this video, guys. We'll meet up in the next video. If you like this video, do like, share and subscribe this channel for more similar videos, and don't forget to press the bell icon below. Thank you.